All right, so this is variable costing. Like I said, I think it's an easier chapter. I'll try to go through it as quickly as I can, and you can still learn it. So in financial accounting and at the beginning of this course, we use something called absorption costing. We never called it that, but what we mean by absorption costing is we absorb the overhead into the product cost. And then last chapter we learned about variable costing, right? That was the first time they gave you the income statement that was framed in terms of a now I'm drawing a blank on the term, but it was different, right? It had all the variable costs up front, and then it had a contribution margin rather than having the product cost and the cost of goods sold. They just laid it out different with a contribution margin. That's what a variable costing income statement was. So that was the first time we dealt with that. So this just kind of goes more into it. So absorption costing to variable costing. Here's the big difference. In absorption costing, our product costs included direct materials, direct labor, and all manufacturing overhead. That was our product costs. And then our period costs were the variable selling and administrative costs and the fixed selling and administrative costs. In other words, direct materials, direct labor, manufacturing overhead were product costs, selling and admin were period costs. That was it. In variable costing, our product costs are our direct materials, direct labor, and the variable portion of manufacturing overhead. And our fixed manufacturing overhead gets charged as an expense of the period. That's the only difference. Okay, and so the rest of this chapter will be me showing you examples of that. Okay. The income statement we used before, sales revenue minus cost of goods sold gave us gross profit, minus selling and admin gave us operating income. Under variable costing is sales revenue minus variable costs give us contribution margin, minus fixed costs give us operating income. So the number at the top, sales revenue, and the number at the bottom, operating income, is the exact same in either case, but the parts in the middle are different. We're going to learn today that they're not always the exact same. Operating income can be different depending on what we include up here. Okay, and you'll see what I mean in a minute. So here's Smart Touch Learning. They always use that company in the examples in both of the textbooks, right, for the two different courses, financial and managerial. So here's, they have a product. They produce 2,000 units. You can see the rest, and we'll use that in the example. So under absorption costing, we have our direct materials, direct labor, and variable manufacturing overhead, and you see that's the same for absorption and variable costing. The difference is the fixed manufacturing overhead gets included in the product cost here under absorption costing, but under variable costing, it's not. It's going to be included down in the next section. So that's the big difference, and that's really the only difference, where the fixed manufacturing overhead goes. Under absorption, it's in the product cost. Under variable, it's in the period costs, lumped together with your selling and admin expenses. The idea is this. If I have fixed overhead, any attempt to divide up that fixed overhead among the number of products becomes arbitrary. In other words, I have some fixed manufacturing overhead cost that never changes, but because this month I produced 1,000 and this month I produced 10,000, I'm going to pretend like that changes my product cost. That doesn't always make sense. Really, your product cost is the same, and that fixed portion of overhead, because it's fixed, is going to stay month to month, and we're going to charge that as a period cost. So that's the rationale behind this, is you have a decision maker saying that fixed portion is going to vary per product radically just depending on the number of products I make. So it's not really a product cost. It's a period cost. All right. So because of this, they're going to give us a different operating income if we produce more units than we sold, or if we produce less units than what we sold. Why? Because let me go back to it. Because we're including the fixed manufacturing overhead in the product costs under absorption costing and not including it on variable, the number of units we sell is going to have an impact on our net operating income. In other words, if I produce a bunch of units and I'm not including that cost of fixed overhead in the unit cost, and then I don't sell all of those units, that cost will be sitting there in my ending inventory until I sell the units in the next period. Okay, so this is going to change things. Hi, Madison, grab a paper. All right, it'll make more sense when we do an example. So again, you can see the income statement under absorption costing has our sales less the cost of goods sold, and cost of goods sold would include direct materials, direct labor, variable manufacturing overhead, fixed manufacturing overhead. That would give us our gross profit less our selling and administrative expenses, gives us operating income. Again, we just went through this, but they're breaking it down one more time because once we get into the numbers of it, you'll see it. Whereas with variable costing, we're going to have sales less the variable costs, which include direct materials, direct labor, variable manufacturing overhead, and the variable portion of selling and admin gives us contribution margin less the fixed costs. So under absorption, we separate manufacturing costs from selling and admin costs. Under variable, we separate variable costs from fixed costs. And in the last chapter, we tried to learn to kind of identify variable costs, fixed costs, and mixed costs, right? That's what we did in chapter 20. All right, so if our production equals our sales, meaning like we produce 2,000 units and we sell 2,000 units. Whether we have beginning, finish, and goods inventory or not, our finished goods and ending will be the same. So for these examples, they tell us just assume that there was none to begin with, and because we sold everything we made, there'll be none at the end. No finished goods inventory left, right? This would be like a manufacturing process that uses just in time. We produced exactly what we needed and we sold those that we produced. It's wonderful if you can do that, right? From an accounting standpoint and from an inventory management standpoint. You know, if I can do it on demand, you say, customer says, I need 2,000, I produce 2,000, ship them out to the customer. And some businesses can do that. Their production process is quick enough that they can just do all production on demand. But most can't, okay? So if that's the case, that what we produced equals what we sell, then our operating income will be the same under both methods. And so here we'll see an example of it. So we'll see that our sales revenue is $1 million minus our cost of goods sold, which was $300 per unit, gives us a gross profit of $400,000. Then we have our selling and admin costs, variable selling and admin, 2,000 units times $62.50 per unit, fixed is $116,000, gives us operating income of $159,000. All right, that's easy. We've done this sort of thing before. If under variable costing, we do our sales revenue is $1 million. Our variable costs include the variable manufacturing costs, the variable selling and admin costs. So contribution margin is $385 minus our fixed manufacturing costs, fixed selling and administrative costs, gives us operating income of $159. So when our production equals sales, our operating income will be the same under either methodology, absorption or variable costing. But when our production exceeds sales, that means if we had no finished goods inventory when we started, here we produce 2,500 and sell 2,000, which means we have 500 units left over at the end. When that happens, our operating income is going to be greater under absorption costing than under variable costing. And what's important during this chapter is that right now I'm just telling you this, and you can write it down in your notes and be like, okay. What's important is that you get to the point where you understand why. So I'm going to try to explain it and show you why, but as you do it is when you'll start to really understand why, right? Or not. you know you could probably get through the homework and get it all right and never really open your brain up to why this is occurring. That's the downside but guess what? It wouldn't be better if I just gave you like paper homework. You still could do the same thing. The reason I try to give you multiple chances is so that you can really try to understand it. But again, we hit the mid-semester doldrums and it's like, I'm no longer trying to learn. I'm trying to get this done so I can go to spring break. I understand. I've been to lots of college myself, guys. Don't worry. I'm not judging you. Well, I'm judging you a little, but not really. All right. So the product price, product cost. Remember, direct materials, direct labor, and variable overhead are the same regardless of the costing method we use. The only difference is that the fixed manufacturing overhead becomes part of the product price in absorption costing, and in variable costing, it becomes part of the period costs. Okay? So when we go ahead and calculate now, so our revenue is the same, right? We sold 2,000 units at $500 per unit, so $1 million in revenue, regardless of the costing system we use. Here they do cost of goods sold, which was 2,000 units times 289 per unit. Gives them gross profit. Selling and admin gives them the operating income of $181,000. And the value of the finished goods inventory will be the 500 units left over times the $289 in cost per unit, or $144,500. Under variable costing, though, now we have the variable costs, which are our variable manufacturing overhead and our variable selling and administrative expenses. Gives us contribution margin. And then we have our fixed costs, giving us an operating income of $159,000. Our finished goods inventory is 500 units times 245 per unit. So my question is, why is operating income higher under absorption costing than it is under variable costing? Anybody think they have an understanding of that from the very quick way I'm describing this? So if revenue is the same, then we must have more expenses being charged in variable costing, right, in order for our operating income to be lower. So there's clue one. Expenses are higher here. Question is why? No guesses? All right, I guess I'll just tell you then. Here's why. So under absorption costing, we took those fixed manufacturing overhead costs and we made them part of our cost per unit. That's why our cost per unit here is $289, but our cost per unit here is only $245. We took that additional cost that we didn't make part of our unit cost under variable costing and charged it as a fixed manufacturing cost. So the entire fixed manufacturing cost was charged as a period cost under variable costing. Whereas here, that fixed manufacturing cost was wrapped up in the cost of the units, meaning it doesn't become an expense until we sell the unit. Then it becomes cost of goods sold. So because there's 500 units left over, there's a portion. In this case, we produced 2,500 units, so 500 out of 2,500, 1/5 of that fixed cost still has not yet been expensed. It's still sitting there in the ending inventory, where all of that fixed manufacturing cost was expensed here as part of our fixed costs. I know that's a lot to wrap your brain around, but just remember, under absorption costing, the fixed overhead becomes part of the cost of goods sold, or the part of the unit cost. So if we don't sell all of the units we make, then that expense is still sort of waiting to be expensed in the ending inventory. And it will be expensed in the next period when we sell the units. Whereas under absorption, we expense the whole amount off during the period. So what I see in most of your faces is either zoned out indifference, or the beginning of like, I think I'm starting to kind of understand this. Maybe if I work with it more, I'll get it more. One of the two. Maybe a little of both. All right. So then they give you this really colorful thing that I think is confusing, so I'm going to skip it. But if you really want it, you can. It's in your book, and you can watch this video and like pause on it and be like, oh, this makes perfect sense to me now. But I think it's more confusing. So now we have a reverse scenario where our production is less than our sales. So for example, we have 500 units to begin our finished inventory. We produce 1,500 and we sell 2,000, meaning we have 0 left at the end. So now we've produced less than we've sold. Okay? So when that happens, our operating income under absorption costing will be less than under variable costing. So same thing. Direct materials, direct labor, variable manufacturing overhead are all the same regardless of the method you use. And our fixed manufacturing overhead is charged to absorption costing, but not to variable costing because it's going to be part of the period costs in variable costing. So here, under absorption costing, you see we sell 2,000 units. So our revenue is the same regardless of the costing method. Here our operating income is 137.5 under absorption, and it's 159 under variable. So again, if revenue is the same, in order for net income or operating income to be lower under absorption, it means we had to have more expenses. And the reason we had more expenses is because we had all of this cost of goods sold, which included, now this includes actually some of the fixed manufacturing overhead from this period, plus some from the previous period that was captured in those units that were sitting there waiting to be sold. So we have more cost of goods sold, more unit or more product cost here than we do under variable costing. Because again, under variable costing, we just charge the full amount of fixed manufacturing overhead for that period during that period. Okay? It'll make more sense as we get to an example. There's the other colorful thing that's confusing. Here's a summary. Also, not sure it would be valuable to spend too much time on it. It's there if you want to go back and look at it. So the other part of this chapter is, okay, so now we know there's this difference between variable and absorption costing. In the end, they always work out to the same over time. But in the period, they can tell us something different. So the question is, how do we use that to make decisions? So managers have to set sales price, control costs, and make plans about how much to produce. So a better understanding of your costs per period versus your costs per product produced can really help with that decision making. That's all they really want to get at there. And that's what we use this for. Like in real life business or when I'm consulting with businesses, honestly, what you want for them to do, I will tell you something. As I analyze the numbers here at EAC, I think we don't have a good handle on what things truly cost us. Because the way our accounting system is right now, teacher salaries get separated from, like when I set my budget as a division chair, I don't get to set the teacher salaries. Those are set by contract, which makes sense. So I can't really trim that part of the budget. Well, guess what 80% of our costs are? Teacher salaries. So it's a non-controllable cost. So it's very hard for me to understand what I really have to pay to do that. And so that is only understood at the very highest levels, the executive leadership, where they start to say, oh, you know, so when I'm supposed to make a decision, what should I do in my program to make it more financially viable for the college, I don't have all the information to do it. Only the big decision maker is, and the big decision maker doesn't want to come down and say, you have to do this, you know, because so it creates this kind of confusion. And that's something that probably over the next year we'll really be looking at hard at EAC, saying, does this program make us money? Does it lose us money? If it's losing us money, do we get rid of it? Do we charge additional program fees? I think a good example is nursing. Nursing is a super expensive program to run, but we don't want to get rid of it. For the students who do nursing, it's a great program. I mean, you leave with a 2-year degree that actually took you 3 years, and you make $50,000 a year. Granted, you have to work as a nurse, which to some people sounds really unappealing, right? And to other people, that sounds like a great career. So we don't want to get rid of it. It's a great program, but we may have to say, do we have to charge course fees or something to cover the costs of it? But in order to do that, we'd have to really understand the costs. I couldn't make that decision. I don't know their costs. Maybe they're doing great, but I know it's an expensive program. So that's what we use this for in real life. And it's important. Whether you're running, chiropractic offices or apartments, you have to understand what the real cost is. I think people look at rental property and they think, oh man, so I pretty much just sit here and people pay money to me? Awesome. You don't realize that whenever the air conditioner goes out, it's the landlord's job to get that fixed. So you've got to factor in the costs. And usually if you build an apartment building and you have to borrow money to do it, just the debt coverage on that alone can make it pretty tight. And then you have one major problem, you could be in trouble. Now, if you have sufficient capital to build it with cash and you're not worried about debt coverage, and then you start to look at it as a pure return. If I spend $100,000 on something and it can return me $2,000 a month, well, think about that. $24,000 a year on a $100,000 investment, less operating expenses. Let's say in the end it brings me, $18,000 a year on a $100,000 investment. Well, that's an 18% return. You can't get that anywhere else. But you've got to think of all of those things. You can't just think like, hey, that brings 24,000. Well, kind of does, gross, but we have operating costs in the middle. So that's what we're doing here. So another concept that we use this for is sometimes we're deciding, I've talked to you about customers who have various products that they sell, and some products make them more or make them less. So this would be like they call it a standard premium decision. Usually we have a standard version of our product and a premium version of our product. And the premium version costs more to produce, but sometimes we can sell it for like even more than that cost. Okay. So using this information of understanding the variable cost and separating out from the fixed costs, which are spread across all the units we make, it can help us make better decisions about how our product, it's called product mix, how much do we want to sell of each kind. Business segments, same idea, right? We have a store in Salinas and a store in Cary. They produce similar sales revenue. It might look like the Salinas store is better because it's doing $665,000 for the same number of sales and units, but contribution margin-wise, Cary actually helps us cover our fixed costs better than Salinas. So that's another way we use this analysis. I just want to sort of introduce you to how this is used in real life. And then here they have profitability. So now they have products and by unit. So now we can see that our standard product is actually doing better for us in contribution margin coverage, and that our Cary stores doing better for us. Doesn't mean they're bad. It just means that, and the reason we want to do that as managers is so we can say, what's this division doing? And is there something we can copy from that and bring over to this store? Especially if sales are the same, right? They both sold 1,250 units, but now we can see mix-wise, Salinas sells more of the premium units and Cary sells more of the standard units. And the standard units are making us a higher contribution margin. So maybe we want to say, hey, let's push the standard unit. Or let's consider our pricing on the premium model. Maybe people will pay more for it because it's a premium. You buy an iPhone. I have an iPhone SE because I like the smaller size of it. It fits in my pocket better. Other people like the big size of the iPhone Plus, right? Whatever. But what are the big factors in the pricing of the iPhone you get? Like what thing is going to impact the price more than anything else? What makes it more expensive? Which iPhones cost more? Huh? The newer version. Okay, so the iPhone 10 or X or whatever it is, I don't know. I don't know if that's a Roman numeral 10 or if it's an X. But it costs more than an iPhone 8. And what else? What's that?
Different camera.
You don't usually get a different camera. Like, can you get an upgrade camera within the same version? No.
Gigabytes.
Yeah, memory. Now let me ask you. So to buy a 16 gig, and they don't have a 32 gig for the SE. So you can get the 16 or you can get the 64. It's $100 more for 64 gigs or 150, something like that. But it's totally worth it, right? Because 16 gigs sucks. It's just not enough. Do you think it costs them $100 more? It's the exact same phone with a different chip. And I bet you that chip is pennies more to produce. I mean, it's still silicon on a wafer, right? Like it's not much different. So they found that by producing a premium product, they could actually increase their contribution margin per unit, right? I add, let's say $5, a $5 chip, and can sell it to you for $100 more. That's the American way, people, right? Like that's a wonderful situation. In my business, my premium product is actually the smaller storage sheds. I charge $70 for a 10 by 20 unit. I charge $40 for a 10 by 10. So for 100 square feet, it costs you $40. For 200, it costs you $70. You're getting like a volume discount. For a 5 by 10, for 50, I charge $30. So if I were to apply that same rate 4 times that would be $120. If I could rent all little storages, I'd actually do better. But people want big storages, right? But they won't pay double of what a small storage is. And so I need to find ways to say, hey, did you know that you can really fit a lot of stuff into that small unit? That's a marketing function, right? If my employees know that the margins are better on unit X, then I want to encourage them to sell unit X. In my case, the smaller units. So when people say, oh, I think I need the big one, what I want them to say is, well, maybe you don't need the big one. And so the customer, it feels like we're selling them the cheaper products so they feel better about it. But to us, what we're saying is we're increasing our margin. So we say, don't commit to that big one. I think you could get your stuff into this smaller one. And then, so if we can do that, if we can do a win-win, if we can sell the cheaper product to this customer, but in the end that increases our margins, then that's really what business is about. Now, sometimes they need the bigger one, but again, we'll try to get them the 10 by 10 before the 10 by 20. Actually, 10 by 10s is my most popular unit, but that doesn't matter. That's business though, right? So that's what all this analysis is really about. That's enough of this. Let's do an example problem. I'm tired of that. All right. So I hope you got the paper. On the paper, there's an example problem, and I'm just going to bring up an Excel spreadsheet here. All right. So this is summary problem. So if you're looking at page 1118, you're on the back side, and that's the wrong side. Flip it over. You want to be looking at page 1117. At the very top, it says summary problem. It says limonade, limonada, I don't know. They incur the following costs for their powdered sports beverage mix. There you can see all their costs. It says there's no beginning inventories, so they have 2,000 cases of powdered mix in ending finished goods inventory because that's the amount they produced. So they produced 10,000 and sold 8,000, so they have 2,000 left. So the first question is, what's their product cost per case under both the absorption and the manufacturing methodologies of costing? So the way we do this is, in essence, I'm going to direct materials, direct labor, variable manufacturing overhead, fixed manufacturing overhead, and total unit cost. That's how I'm going to set this up. Under absorption and under variable. That's what it's asking us for, right? So what's our direct materials cost per case? How much? $8 under either method, right? Because direct materials is always the same under these two methodologies. Direct labor, $3 a case. Variable manufacturing overhead, $2. It's the same. The only place it's different is under fixed manufacturing overhead. Under absorption, our fixed manufacturing overhead will be part of our product costs, and it tells us that they had $50,000 in fixed manufacturing overhead costs. So I'm going to say this equals $50,000 divided by the number of cases produced, which in this case was 10,000. So our fixed manufacturing overhead, $5. So our total unit cost under absorption was $18, and under variable, $13. What's the difference? The fixed manufacturing overhead. Where does the fixed manufacturing overhead go? It's going to be included in the period costs under variable costing. Okay. So question 2 says, prepare income statements for Lemonade on March 2016 using absorption costing and variable costing. So under absorption, we're going to have our sales revenue minus our cost of goods sold. That'll give us our gross profit, right? This is back to accounting 1. And then our gross profit minus our selling and admin expenses will give us our operating income. So our sales revenue, they sold 8,000 cases times $25 a case. So I'm going to say that equals 8,000 times 25. Our cost of goods sold, we sold 8,000 cases, and we figured out our unit cost, so 8,000 times the $18 a case, right? Our gross profit will be our revenue minus our cost of goods sold. And our selling and admin expenses are given to us as fixed selling and admin costs of $25,000. You see that in the information given on the first page? So our operating income then will be our gross profit minus our selling and admin expenses. So there's our absorption costing income statement. Did everybody follow what I did there? I went fast, but it's not really new, right? We've done this sort of thing all through accounting 1. All right, so our variable costing income statement is also going to start with sales revenue, which is also, we sold 8,000 cases at a cost of, what was the sales price per case? $25 a case. And then we're going to do our variable manufacturing costs, which were the number of cases that we sold, which was 8,000, times our unit cost per case, right? So $104,000. That's going to give us our contribution margin. So sales revenue minus variable manufacturing costs. Then we'll have our fixed costs, which will include our fixed manufacturing costs and our fixed selling and administrative costs. Fixed manufacturing costs was $50,000. And our fixed selling and administrative was $25,000. So our operating income, contribution margin minus the fixed costs, $21,000. So the big question is, why is it different? Here it was 31,000. Here it was 21,000. And the answer is, the reason it's different is under variable costing, we accounted for all of the fixed manufacturing costs for the month, all $50,000 worth of them. Under absorption costing, we put those fixed manufacturing costs into the units, right, at $5 per unit, and then we didn't sell all of the units. So some of those fixed manufacturing costs are still sitting there in the value of our ending inventory. We only charged off as an expense the amount that was in the units we sold. That's the difference between the two. Under variable, we do all of the fixed manufacturing costs as a period expense. And absorption, we make the fixed manufacturing costs a part of the product cost. And then if we sell all of the product, we get to claim all of the fixed manufacturing as an expense. In this case, if we don't sell all of it, we don't get to claim it all as an expense yet. Next month, when we sell those units, it'll be an expense then. Okay? That's really, this whole chapter is about learning that one concept, really. And so after you do it a few times, I think it'll click. Third, calculate the balance of the finished goods inventory on March 31st using absorption costing and variable costing. So I'll just do that out here, finished goods. In essence, it'd be the number of units we have left over, right, which is 2,000. Because we produced 10,000, we sold 8. So 2,000 units times the unit cost. So under absorption costing, it's 36,000. And under variable, it's going to be the 2,000 units that are left over times the $13 per unit cost, or 26,000. Requirement 4, reconcile the difference between the operating incomes and finished goods inventory balances between the two costing methods. Okay. So what I'm going to do is I'm going to say I've got my operating income and my finished goods inventory. So under absorption costing, my operating income was $31,000. Under variable costing, my operating income was $21,000. And my difference, I'm just going to say equals absorption minus variable. So my difference is $10,000, right? My finished goods inventory under absorption was $36,000. I'll just, right here. And under variable, it was $26,000. Whoops. Under variable, it was $26,000. So my difference is $10,000. So when it says reconcile the difference, we recognize that the difference between the inventories is still $10,000. And what is that $10,000? It's the amount that was charged as a period expense right here. Really, I think to reconcile it, we'd have to look at fixed manufacturing costs under variable were $50,000. And the amount of fixed manufacturing overhead charged under absorption was $5 per unit times the number of units sold, which was 8,000. So it was $40,000, and that difference is the $10,000. To me, that reconciles it better, but that's not what they asked for. No, they would always balance. The difference in your operating income and the difference in your finished goods inventory will always be the same. Okay? And where did it go? It went as a period expense under variable. All right, so I hope where you're at right now is like, I think I'm starting to kind of wrap my brain around this, but I need to look at it more. Unless you're Austin, you've already done the homework, so I don't know. Now you're like, I got to look at that again. but I probably won't because spring break's in 2 days. Let's just be honest. Anyway, so I hope that made some sense, or at least it got you to where the homework will make more sense to you. Have a great day. We'll see you Friday. Some of you I will see in a couple of hours.